The best time to convert a traditional IRA into a Roth is if you have a year with unusually low income. Maybe you're self-employed and just had a bad year, or took a long vacation that cut into your working hours. Maybe you had a baby and decided to work part-time. That would be a good year to convert your traditional IRA into a Roth because you'll have lower taxable income and the tax bite will be less. When your business returns to normal or you return to work full-time, your tax rate will go up again, but that won't affect your Roth. You might be wondering which type of IRA is right for you. Traditional IRAs are still the most common type of IRA. I think there are two reasons for that. First, Congress authorized traditional IRAs almost 25 years before it authorized Roths. That's a big head start. Second, based on just expected tax rates, most investment advisors recommend the traditional IRA over the Roth, assuming that you qualify for both. The idea is that you'll withdraw the funds after you retire when your income is lower. That should translate into lower tax rates for most people. That makes sense if, and it's a big if, tax rates stay about the same as they are now. You can make a good case that's not going to happen. People look at the growth in U.S. government debt and wonder how the federal government can possibly repay its obligations. In 1966, for example, the federal debt was about $320 billion. 10 years later, it was a little less than double that, or about $600 billion. 10 more years, and it had more than tripled to almost $2 trillion. 10 more years, and we're at $5 trillion. Just from 2009 through 2013, the federal debt increased about 50%, and there's no real sign of the explosion in federal debt slowing down very much, let alone declining. Expressed as a percentage of gross domestic product, or GDP, the picture is a little better, but far from reassuring. Looking at evidence like this, many people believe that taxes are going up, perhaps a lot. If they're right, then your taxes could be higher at retirement than they are now, even if your income is lower. I don't pretend to know what your taxes are going to be when you begin to withdraw funds from your IRA. From a tax perspective, it wouldn't hurt to have both types of accounts. Your Roth IRA will pay off handsomely if tax rates rise because you paid the taxes up front. Your traditional IRA will pay off if they don't rise because you'll pay the taxes at withdrawal. You're ultimately going to be guessing on those tax rates. Good luck. But don't miss the forest for the trees. Regardless of what happens to tax rates, either type of account will beat a fully taxable account. A traditional IRA avoids taxes on the contributions up front. A Roth avoids them on the earnings down the road. But you pay the taxes on both with a taxable account. Even if you pick the wrong type of IRA, you've done yourself a favor by starting one. You might not be quite as far ahead as you would have been if you made the right choice, but even the wrong choice puts you ahead of where you'd have been with a taxable account. By way of comparison, Canadian citizens have access to something quite similar to a Roth IRA. That's the tax-free savings account, or TFSA for short. Contributions to a TFSA don't generate a tax deduction, but earnings are tax-free. Just like a Roth, Canadians can put stocks and mutual funds in the TFSA. Annual limits are about the same too. The TFSA has one big advantage over the Roth though. If you don't fully fund your TFSA in 1 year, then the unused amount carries forward. You can make it up the next year. U.S. citizens can't do that with a Roth. In the United Kingdom, the closest thing to an IRA is a self-invested personal pension, or a SIP. Like an IRA, a SIP is essentially just a label you attach to retirement investments. UK citizens get a tax break on contributions, but lose access to their funds until certain requirements, mostly related to age, are met. Many U.S. companies offer their employees 401